Welcome to this week's Market Outlook. This is a calm, unbiased review of stock market performance, the forces driving price movement, and what investors should observe, not react to, going forward. This commentary is for market understanding and education, not for trading or investment advice. Market Snapshot. Over the past week, global stock markets showed mixed performance, reflecting continued uncertainty rather than a clear directional trend. Equity markets moved within a narrow range, signaling hesitation among investors rather than strong conviction. Volatility remained elevated, but not extreme. This suggests markets are currently in a digesting phase, absorbing economic data, central bank messaging, and earnings expectations, rather than entering panic or euphoria. Overall sentiment can be described as cautiously neutral. What moved the market this week? Three primary forces influenced market behavior this week. First, interest rate expectations continued to dominate investor thinking. Markets are highly sensitive to any signals suggesting rates may stay higher for longer. Even small changes in expectations can lead to noticeable price swings. Second, economic data releases, particularly inflation-related indicators, kept investors alert. While some data points showed signs of cooling, others reminded markets that inflation risks have not fully disappeared. Third, corporate earnings guidance, not earnings numbers themselves, played a key role. Investors are paying close attention to forward-looking statements, especially regarding margins, consumer demand, and cost pressures. Together, these factors kept markets range-bound rather than directional. Expert interpretation. What this really means. From an expert perspective, this type of market behavior is not unusual, and not necessarily negative. Periods of sideways movement often occur when markets are transitioning between narratives. Previously, the dominant story was aggressive rate hikes. Now, the story has shifted to how long restrictive conditions will remain. This creates uncertainty, and uncertainty creates hesitation. Importantly, there are no widespread signs of institutional panic. At the same time, there is also no broad-based aggressive buying. This tells us one key thing. Markets are waiting for confirmation, not guessing. For long-term investors, this phase rewards patience more than activity. Historically, many costly mistakes are made when investors try to force clarity during unclear conditions. Sector-level observations. Defensive sectors have shown relative stability, suggesting that some investors are positioning cautiously rather than aggressively. Growth-oriented sectors remain sensitive to interest rate expectations, reacting quickly to any shift in bond yields. This is a selective market, not a broad rally or broad sell-off. Stock selection and balance sheet strength matter more now than momentum. Closing wisdom. Markets do not reward urgency, they reward discipline. In uncertain environments, clarity comes to those who wait, not those who rush. Thank you for listening to this week's Market Outlook. We'll return next week with another calm, structured perspective on market movements and expectations.